Welcome to the Deep Dive. We're TalkTickers, and our mission is really to cut through the noise of these earnings calls, these corporate reports, and just bring you the insights that matter.
Yeah, exactly.
Today, we're doing a deep dive into the recent first quarter fiscal 2025 earnings call for GAP Inc. We've listened to the call, gone through the numbers, heard the commentary, looked at the outlook.
Right.
Think of this as your shortcut to understanding what's really going on inside one of the biggest names in retail right now.
Absolutely. And they covered a lot of ground on this call. I mean, everything from how the individual brands are doing, Old Navy, Gap, right down to the nitty-gritty operational stuff.
Like the supply chain?
Exactly. Supply chain diversification and, the potential hit from new trade policies. It paints a picture of a company that feels like it's hitting its stride strategically, but still dealing with the complex world out there.
Absolutely. And let's not bury the lead here. The headline from Q1, it's definitely solid performance. They actually exceeded their own expectations across the board.
Yeah, they did.
We saw overall comparable sales for the company as a whole jump 2% year over year.
And that 2% comp, it isn't just, a nice number to look at. It really drove efficiency down the income statement.
How so?
Well, they talked about expanding gross margin by, 60 basis points compared to last year, and importantly, leveraging SG&A.
Selling, general, and administrative costs.
Right, leveraging that by 90 basis points. So basically, their fixed costs grew slower than their sales, which makes that top-line growth really count.
Which is why you saw that flow through to operating profit, right? Operating margin improved quite a bit, up a solid 140 basis points year over year. Hit 7.5% for the quarter.
Yeah, and that went straight to the bottom line. Earnings per share saw really strong growth, up 24% year over year to 51 cents. Those are definitely strong improvements.
They also made a point about the balance sheet health.
Solid cash position. They finished the quarter with about $2.2 billion in cash.
That's a good cushion.
It is, and they're clearly putting it to use, returning capital. Gave back about $131 million to shareholders just in Q1.
Through buybacks and dividends.
Yep, both. That cash gives them a lot of flexibility, for investments or whatever comes next.
And the tone from management. It sort of reflected these results, didn't it? Noticeably optimistic, I thought, but also grounded.
Yeah, realistic optimism, maybe. They kept emphasizing disciplined execution, making strategic progress, focusing on what they can control.
Right, in what's still a pretty volatile retail environment.
Exactly. It wasn't just, hey, look how great we are. It was acknowledging the work behind the numbers and, the challenges still out there.
Okay, so let's unpack the story brand by brand, because this is where that reinvigoration journey, as they called it, really comes to life. Each brand is genuinely in a different spot.
Right. Starting with Old Navy. It's the engine of the portfolio, their biggest brand by far.
And they had a strong start to the year. Comps up 3%.
Yeah, 3%. And for a brand that size, that's significant. What really stood out to me, though, was that this marks their 9th consecutive quarter of market share gains.
9 quarters straight.
Wow. Yeah, it really cements their position as the #1 specialty apparel brand in the U.S.
What's driving that consistency? Is it broad-based?
It seems to be. What's fascinating about Old Navy in Q1 is they saw growth across all income levels. They talked about gaining share in both the top and the bottom income groups.
Oh, like both ends.
Yeah. It suggests that core value value fashion for the whole family is just resonating really broadly right now.
And did they call out any specific categories?
Oh, yeah, absolutely. Activewear was a big one. They highlighted the success of their new Studio Smooth collection.
Right, and that New Moves campaign.
Yeah, with Lindsay Lohan and Dylan Efron. Seems like that got some traction. Denim also continued to be strong. They mentioned trend-right styles like loosened barrel fits doing really well.
Helping them hold that #4 spot in adult denim.
Exactly. And then the occasion dress collection and the core kids and baby business were also called out as performing well.
And it wasn't just product, right? They mentioned tech investments too.
Yeah, things like rolling out AI-powered RFID in stores for better inventory management and plans for that big new flagship store in Herald Square in New York seems designed to keep the momentum going.
Okay, makes sense. Let's switch to the Gap brand itself. That one had a really standout quarter.
It really did. Delivered a 5% increase in comparable sales in Q1.
5% is impressive on its own, but the context, like you said, with Old Navy, makes it even more so. This is their 6th straight quarter of positive comps.
An 8th straight quarter of market share gains.
Right. That's not a blip. That signals real momentum, increasing relevance for the core Gap brand after, years of challenges, let's be honest.
It really suggests the strategic work is paying off. They talked about building a much more consistent brand narrative.
The Feels Like Gap campaign.
Exactly. And women's performance was highlighted as particularly strong.
And like Old Navy, denim is still foundational for Gap.
Oh, yeah. Gaining share there, too. And they're rolling out an enhanced denim experience in some top stores, supposedly based on learnings from their Flatiron store.
Collaborations seem like a big theme for Gap, too.
Huge emphasis. Partnerships with Harlem's fashion road Doan Tooney, and that new Gap Studio collection by Zach Pozen.
How are those performing? Just buzz or actual sales?
They said these collabs are bringing in new customers, driving engagement, and this is key, seeing strong full-price sell-through.
Ah, full price. That's the indicator.
Right. It suggests it's not just hype, it's helping them test pricing power and showing that this more elevated design direction can work for them.
So it sounds like Gap is hitting multiple demographics, gaining in those top and middle income groups, and kind of bridging the generation gap successfully.
Seems that way. Now, shifting gears a bit, Banana Republic, clearly in a different phase, comps were flat in Q1.
Right. They're trying to reestablish it as a premium brand, and that takes time. It's a deliberate effort.
Exactly. Focus is on fixing fundamentals. The good news, they said, is they're seeing improvements, particularly as their new pricing structure takes hold.
Any specific areas doing better?
Men's performed well, apparently, and women's is improving, specifically in things like coats, skirts, and pants. They acknowledged needing better alignment between design and merchandising across genders, though.
That White Lotus collaboration got a specific shout out.
Yeah, they seemed pleased with that one, said it generated significant impressions, brought in new customers, but stayed true to the brand's sort of travel and adventure aesthetic, using storytelling.
So experimenting with how to reconnect with that premium customer.
Seems like it. It felt more integrated than just, slapping a logo on something. Okay, now, Athleta.
The tough spot.
Yeah, this remains the most challenging part of the portfolio right now. Comps were down 8% in Q1.
Ouch. And management was pretty frank about the issues, weren't they?
They were quite candid. They acknowledged what they called an over-rotation towards a newer, more trend-focused customer. Meaning, basically, they didn't have enough compelling stuff for their large existing customer base, the people who built the brand originally.
So they alienated their core.
That seems to be the implication. They're investing in design talent now to try and reset this, but they explicitly said expect this year to be choppy. They need to fix those fundamental product issues.
It's a good reminder that turnarounds aren't always smooth sailing.
Definitely not linear. So yeah, Old Navy and Gap showing real momentum, but Athleta clearly needs significant work and probably some patience.
Okay, let's zoom out from the brands. Look at the overall financials and operations. There were some interesting nuggets there too. You mentioned that gross margin expansion, 60 basis points.
Right, and they said that was driven entirely by something they called ROD leverage.
ROD leverage. Okay, what exactly does that mean in plain English?
It's a term you hear sometimes in retail, usually refers to operational efficiencies or cost savings related to the physical store footprint and the supply chain feeding those stores.
Like rent or distribution costs?
Yeah, think optimizing distribution routes, maybe better lease terms, getting more efficiency out of store staffing relative to sales, since they've spent years closing underperforming stores.
Right, optimizing the fleet.
Exactly. This leverage suggests those efforts are now paying off in terms of cost benefits, separate from the cost of the actual goods. They noted merchandise margin itself was relatively flat year over year in Q1.
Ah, okay. So the margin gain wasn't from selling stuff for more, it was from running the stores more efficiently.
Precisely. Getting more bang for their buck out of the physical infrastructure.
And you also mentioned SG&A leverage.
Right. SG&A expenses were flat year over year. Since sales were up, flat expenses means lower costs as a percentage of sales. That's the 90 basis points of leverage. Shows continued discipline on overhead, marketing spend, etc.
Got it. Inventory levels were up 7% year over year. Any concern there?
They didn't seem too worried. They put that down mainly to getting shipments earlier and faster transit times, which is actually a sign of supply chain improvement.
So the right stuff, just arriving sooner.
That was the message. They felt the composition was appropriate, not sitting on piles of old inventory.
And capital allocation. Still focused on investing back and returning cash.
Seems clear. They spent $83 million on CapEx in Q1 Think Technology, supply chain improvements.
Okay.
And combine that with the $131 million returned to shareholders via dividends and buybacks, plus that big $2.2 billion cash balance. It shows they have the financial muscle to invest while rewarding investors. That strong balance sheet is a definite plus in uncertain times.
A major focus they discussed, and you touched on it earlier, was supply chain diversification, particularly getting out of China.
Yeah, this is a really significant strategic shift they've been working on. They highlighted China is now less than 10% of their total sourcing.
Down from being a top country not that long ago.
Right. And they expect that to be less than 3% by the end of 2025.
Wow, under 3%. That's a dramatic shift. What's the longer-term goal?
Very ambitious. By the end of 2026, they want no single country to be more than 25% of their sourcing.
Taking risk.
Exactly. They mentioned Vietnam and Indonesia as key growth spots right now, and they also specifically called out plans to double their sourcing of American-grown cotton by 2026.
Interesting. So it's not just about tariffs, it's about resilience.
That seems to be the core idea. Building agility, reducing reliance on any one region to avoid disruptions. Makes a lot of sense.
They also mentioned prioritizing tech investments.
Yes. Putting money into things like better inventory management systems, digital product creation tools, AI capabilities, and strengthening their e-commerce. They proudly noted they're the #1 apparel e-commerce business in the U.S.
Gotta invest to keep that spot.
For sure. And interestingly, they even touched on company culture. Called it a superpower.
A superpower. How do they define that?
Framed it as creativity, resilience, purpose. Said it helps them navigate disruption and build a more focused, energized organization. Harder to measure than comps, obviously, but management clearly thinks it's important.
Okay, so putting all this together, what's the outlook for the rest of fiscal 25? They reaffirmed guidance, but with a huge asterisk, right?
Exactly. They reaffirmed their outlook, excluding the potential impact of tariffs. So the baseline expectation for the full year is net sales up 1% to 2%.
Okay.
They expect slight underlying gross margin expansion this time, coming from roughly equal parts ROD leverage and some merchandise margin improvement. SG&A should leverage slightly, and underlying operating income growth is pegged at 8% to 10%.
And that baseline assumes Old Navy and Gap stay strong, Banana Republic stabilizes, but Athleta takes longer.
Correct. And they're still planning to reinvest some expected cost savings into growth projects.
Okay, but then you have to factor in the tariffs.
Right. This is the big variable. They gave a separate estimate based on current tariffs, 30% on some China goods, 10% on others. The gross incremental cost for the full fiscal year could be between $250 million and $300 million.
That's a massive number.
It's huge. Now, how are they planning to handle that?
Yeah, what's the mitigation plan?
They said they currently have strategies, things like adjusting sourcing locations, manufacturing processes, even tweaking product assortments that they believe can mitigate more than half of that gross amount.
Okay, so more than half. What does that leave as the net hit?
The estimated net impact to fiscal 2025 operating income is about $100 million to $150 million.
Still significant.
Still very significant. And they noted this impact will mostly hit in the second half of the year. They stressed it's dynamic. They're working on more mitigation over time, trying not to hurt the long-term strategy or customer value.
And they're tightening inventory buys for the second half.
Yeah, just to maintain flexibility given the uncertainty around tariffs and maybe broader consumer spending.
And just quickly, the outlook for Q2 specifically.
For Q2, they expect net sales roughly flat year over year, partly because they're lapping a benefit from a credit card agreement renegotiation last year.
Tough compare.
Exactly. Gross margin in Q2 expected to be similar to Q1's level, but that actually means a year-over-year decline compared to last Q2, again, mostly due to lapping that same credit card benefit. SG&A should leverage slightly, and minimal tariff impact expected in Q2 itself.
Okay, so for you, the listener, trying to piece this all together, Q1 was solid. Real progress at Old Navy and Gap, driven by good execution on product, marketing, supply chain.
They're financially strong, which lets them keep investing in those key long-term things like tech and that big supply chain shift away from China.
Athleta is the clear weak spot, needing that reset. Management seems aware.
Very aware. And while the underlying business outlook is okay, those potential tariffs are a material headwind for the full year $100 to $150 million net hit expected, even with mitigation. Watching how they navigate that in the back half will be crucial.
That ability of their portfolio, Old Navy, Gap, BR, to appeal across different income levels feels like a key strength in this environment, doesn't it?
It really does seem to be. The question, as always, is how much of this the good stuff at Old Navy and Gap, the Athleta challenges, the tariff impact, is already baked into the company's current valuation by the market.
All right, time for our This Is Not Financial Advice segment. Just a reminder, everything we talk about here is purely for informational and entertainment purposes. It should absolutely not be taken as investment advice.
Definitely not. We're just exploring ideas based on the public info. Always do your own homework. Talk to a qualified financial advisor.
Okay. But given that really explicit focus GAP Inc. put on dramatically accelerating diversification away from China sourcing, aiming for under 3% by end of 25, and that specific mention of doubling American-grown cotton sourcing.
Those are interesting call-outs.
Is an outrageous but plausible trade idea. Think like a speculative hedge fund analyst for a second. Call it the GAP Inc. supply chain reshuffle pair trade.
Okay, I'm listening. A pair trade.
The idea. You could go long on maybe some key domestic textile manufacturers or specific U.S. cotton suppliers that stand to benefit significantly if GAP Inc., and maybe others following suit, really do ramp up domestic sourcing because of tariffs or risk concerns.
Right, betting on the suppliers.
Or, simultaneously, maybe go long on select apparel manufacturers in places like Vietnam or Indonesia, countries GAP explicitly mentioned as growth areas, betting they'd gain volume.
Okay, that's the long side. What's the short?
The other side of the pair. You look to short a publicly traded competitor, ideally one that seems less agile or has been slower to announce big diversification plans, that still has a very high publicly known reliance on China for manufacturing.
Or maybe one whose whole supply chain is just deeply optimized for China import.
Exactly. The bet is that they will face much greater margin pressure and operational headaches from tariffs and supply chain knots compared to a company like GAP Inc., which seems further along in shifting things.
So you're basically betting that these supply chain shifts aren't just a GAP story, but a broader trend creating winners and losers among the suppliers and hitting companies differently based on their starting point and speed of change.
Precisely. It's a bet on the ripple effects of global trade policy hitting the manufacturing layer and GAP being potentially better positioned than some others.
Definitely thinking outside the box there, focusing on the infrastructure behind the brands. Plausible, like you said, but certainly carries plenty of risk.
For sure. Okay, let's wrap up our deep dive into the GAP Inc. Q1 2025 earnings call. The key takeaways feel pretty clear, right? Solid underlying business performance, really driven by that brand reinvigoration, especially Old Navy and Gap.
Yeah, the execution seems effective there. And their financial health is strong, which is enabling continued investment in tech and those really crucial supply chain changes.
But they face that material headwind from potential tariffs, mostly in the second half. They're actively working on mitigation, adjusting sourcing and operations.
And Athleta remains the main challenge, needing that fundamental reset, which management acknowledge will take time. So it's a company performing pretty well while also navigating significant strategic shifts.
So as you process all this information, what really stands out to you the most? How do you think these big established companies like GAP Inc. manage that complex dance? Operating the business day to day, dealing with unpredictable global stuff like trade policy, while also staying focused on huge long-term goals, like turning around brands and totally overhauling the supply chain.
It's a massive juggling act.
It really is.
Yeah.
Definitely something to keep thinking about as we watch how the rest of their year unfolds.